People often ask me, Jim, what's the biggest mistake ordinary folks make with their money? And I always give the same answer, one that usually makes them blink a few times. Keeping too much cash in the bank. Yes, really. The bank, that place everyone thinks is the safest spot on earth, I'm here to tell you it's not. Not for your long-term wealth. Not if you want your money to actually do something. Most people grow up believing that the safest place for their money is the bank. It feels secure, steady, predictable. You deposit your paycheck, the numbers show up on the screen, and there's this comforting illusion that your money is protected and waiting for you. But what most people never realize is that keeping too much cash sitting in a bank account is actually one of the most quietly damaging financial habits you can have. It's not dramatic, it doesn't make noise, it doesn't cause panic. It just slowly erodes your financial potential in the background. And because it happens inch by inch, year by year, people don't notice the real cost until it has eaten away at a decade of their earning power. The problem isn't the bank itself. The problem is what cash does when it sits still. Because cash that doesn't move doesn't grow, and cash that doesn't grow gets weaker over time. Inflation is the invisible force behind this. Every year, prices rise. It's not always huge, but it's continuous, and that slow upward creep means your dollar buys less in the future than it buys today. If your savings account is paying you 1% while inflation is running at 3, 4, or even 5% during tougher economic periods, you're effectively losing money without ever seeing a negative number. It's a loss disguised as stability. Most people don't see that because the bank statement stays positive, but the purchasing power underneath is slipping away. Wealthy people figured this out a long time ago. They realized that letting cash sit idle is like leaving your car in the driveway with the engine running but never moving it. It burns fuel but doesn't take you anywhere. Money needs movement. It needs direction. It needs to flow into places where it can multiply, protect itself, and create opportunity. That's why the wealthy only keep the amount of cash they actually need for emergencies or immediate expenses. Everything else is allocated with intention. They understand that emotion is what makes average people cling to cash. The fear of losing money in markets, the comfort of seeing a balance that doesn't fluctuate, the belief that at least I know my money is safe here, but safety that guarantees loss is not real safety. The wealthy instead look at cash as temporary. They don't see it as something to hold, they see it as something to deploy. They know that if they want growth, stability, freedom, or long-term security, cash alone can't deliver it. It's simply a tool. So when ordinary people sit on piles of cash in a savings account, thinking they're doing the responsible thing, what they're really doing is letting time work against them. $10,000 today won't have the same value 10 years from now, and the bank won't bridge that gap. The interest it pays is often just enough to convince you that something is happening, even though it's barely a fraction of what you lose to inflation. This mindset shift is what separates people who build wealth from people who stagnate financially. It's not about taking excessive risk. It's not about gambling or chasing hot investments. It's about recognizing that standing still is its own kind of risk. The world evolves, prices rise, economies shift, and if your money isn't positioned to keep pace with those changes, you fall behind even while doing what feels safe. Once you see cash this way, you realize that the real danger isn't in markets moving up and down. The real danger is in thinking that stillness equals protection, when in reality it quietly chips away at your future without ever announcing that it's happening. Inflation is one of those forces that people know exists, but they rarely stop to think about how deeply it affects their everyday life. It's subtle, almost invisible, and because it doesn't happen in one dramatic burst, people underestimate its power. But inflation is like a slow leak in a tire. You don't notice it right away. You keep driving, everything seems fine, and then one day you realize the car isn't handling the way it used to. By the time most people recognize what's happening, inflation has already eaten away a significant chunk of their purchasing power. This is the quiet destruction that happens when you let too much cash sit idle, especially in a bank account that pays almost nothing in return. The tricky part is that inflation doesn't show up on your bank statement. Your balance stays the same, the number looks stable, and that tricks your mind into believing everything is fine. But what stability hides is the fact that the value behind that number is shrinking. The same money that could buy you a cart full of groceries a few years ago now buys a basket. The same $50 that once filled your gas tank now barely gets you halfway. Prices climb gradually, but relentlessly, and every dollar sitting still loses its ability to keep up. People often say, at least my money is safe in the bank. But safe from what? Your bank protects your money from theft, yes, but it cannot protect it from erosion. And erosion is exactly what happens when your savings earn 1% interest while inflation rises at 3, 4, or even more during turbulent economic periods. That gap might not seem like much in a single year, but compounding works both ways. Just as interest can make your money grow exponentially, inflation can make your purchasing power shrink exponentially. What feels like a small loss now becomes a massive loss later. Wealthy people understand this instinctively. They don't leave large amounts of cash sitting around because they know inflation is constantly working against them. They've learned that dollars today are worth more than dollars tomorrow, which is why they focus on putting cash into assets that can outpace inflation or at the very least keep up with it. They treat cash like a temporary visitor, not a long-term guest. It stays just long enough to serve a purpose before being moved into something that actively works for them. But for the average person, the comfort of seeing a static number in a bank account often outweighs the discomfort of watching investments fluctuate. People get attached to the idea of stability. They like the illusion of control. If the number doesn't move, they think they're safe. But inflation is always moving. It never stops. Every day, prices across the economy adjust. And every day, your stagnant cash steps one pace behind. When you add years or decades to that equation, the damage becomes undeniable. Think about someone who kept $20,000 in savings 10 years ago. That $20,000 is still there today, untouched, unchanged, which sounds responsible, but if you compare what that same amount could buy then versus now, you'll see how much value disappeared quietly. Rent went up, food prices went up, energy costs went up, healthcare skyrocketed, and the money didn't grow enough to keep up with any of it. Inflation doesn't need permission to take its share, it just does. That's why wealthy people don't fear inflation, they plan for it. They structure their finances in a way that acknowledges the reality of rising prices instead of pretending cash can magically resist it. And that's the mindset shift most people need. Inflation isn't just an economic concept you see on the news. It's a daily force shaping your finances, whether you pay attention to it or not. Once you understand that inflation never sleeps, never pauses, and never stops shaving off the value of stagnant money, you realize that letting cash sit idle isn't safety at all. It's surrender. One of the biggest differences between the financially successful and everyone else is how they treat the money that lands in their hands. Most people think of cash as something to hold, something to store away, something to cling to, because seeing a solid number in their account makes them feel secure. But wealthy people see cash in an entirely different way. They don't let it sit still, they don't let it get comfortable, and they definitely don't let it sleep. They give every single dollar a purpose, a task, a job. To them, money is energy. It has to move, it has to circulate, and it has to be put to work. Idle money is wasted potential, and wasted potential is one of the few things truly wealthy people refuse to tolerate. When you think about it, this mindset makes a lot of sense. Cash on its own doesn't grow. It's like a seed that never gets planted. It just sits there in the packet, looking like it could become something meaningful, but never actually turning into anything. Wealthy individuals understand that if they want their money to help them build more freedom, options, and stability, then that money needs to be actively involved in the process. They don't stash it away out of fear. They deploy it strategically. They look at their dollars and ask, where can you provide the most value? Where can you generate more? Where can you protect the rest of the portfolio? It's a completely different relationship, one built on intention rather than emotion. People who aren't used to this way of thinking often hold on to cash because it feels like control. They feel like as long as the money is sitting in the bank, it's safe. But wealthy people know that the only thing cash guarantees is stagnation. If it's not invested, allocated, or put to work in a system designed to grow, then it's slowly losing relevance. This is where the wealthy approach things from a place of logic rather than fear. They've trained themselves to view cash as a temporary state, something that exists between investments, not instead of them. That's why they might hold cash briefly while waiting for the right opportunity, an asset to buy, a business to fund, a market dip to take advantage of, but they never let it linger without a plan. This mindset also gives them agility. When their money always has a job, they're constantly positioning themselves to benefit from movement. They're not reacting to the economy, they're participating in it. Meanwhile, the average person is often paralyzed, waiting for the perfect time or obsessively protecting their savings because they fear making the wrong move. And ironically, that hesitation ends up costing more than any market swing ever could. Wealthy people avoid that trap by designing systems where their money flows automatically into investments, into opportunities, into assets that expand their net worth instead of assets that anchor it. Another important piece is that wealthy people don't view money through the lens of scarcity. They're not thinking, if I lose this, I'm done. They're thinking, if I deploy this intelligently, it will come back multiplied. Their confidence isn't blind optimism, it's built on experience. They've seen how money behaves when it's put to productive use. They know that a well-diversified, well-allocated portfolio is far safer than a pile of cash sitting in a bank account pretending to be secure. So they spread their money across different income streams, different asset classes, and different time horizons, making sure each dollar contributes to the overall structure of their wealth. Over time, this philosophy compounds into something powerful. When every dollar is given purpose, your financial life becomes a living system rather than a stagnant pond. Growth becomes consistent, momentum builds, and opportunities start appearing more often because your money is already positioned to take advantage of them. This is why wealthy people seem to always have something working in their favor. They've simply trained themselves to never let cash sit idle. They understand that financial success isn't about how much money you hold. It's about how effectively your money works while you sleep, live, and make decisions. And once you start thinking of cash as an employee instead of a trophy, everything about the way you build wealth begins to change. Short-term government securities might sound like the dullest topic on earth, but if you really take a moment to understand how they work and why wealthy people rely on them, you start to see just how powerful they are in a world where most people let their money sit passively in the bank. The wealthy don't chase excitement. They chase efficiency, safety, and smart returns. They know that the goal isn't to make every dollar explode with growth, but to keep every dollar protected while still moving forward. And that's exactly what short-term government securities offer. They're like the financial equivalent of a well-built shelter, strong, steady, reliable, and always there when you need them. Most people overlook these because they seem boring, but boring is often where true financial wisdom hides. These securities are backed by the government, which means you're essentially lending money to one of the most stable entities in the world. That alone gives them a safety profile that banks simply can't match. And while a traditional savings account might throw you a tiny bit of interest, just enough to make you think something useful is happening, short-term government securities generally offer higher yields without exposing you to the wild. Swings of the stock market. They sit in that sweet spot between growth and security. And that's exactly why wealthy people love them. Another reason they gravitate toward these is liquidity. Short-term securities mature quickly. You're not locking your money away for decades. You can access it relatively soon. Wealthy people want flexibility. They want to be able to grab their money when a new opportunity arises, whether that's an investment opening up, a market dip to take advantage of, or a strategic move they've been waiting to make. A lot of people don't realize how important liquidity is until they need it. The wealthy plan around it from the very beginning. And then there's the strategy of laddering, which sounds complicated but is actually incredibly simple. Instead of buying one security that matures at a single point in time, wealthy people spread their money across multiple short-term securities with staggered maturity dates. That way, something is always coming due. It's like having rolling access to your money, consistent liquidity, without sacrificing returns. It keeps the door open without leaving everything exposed. Think of it as a conveyor belt where money constantly replenishes itself right back into your hands. This stability also plays a huge role in their overall financial system. When you build wealth, you need a foundation that isn't vulnerable to every mood swing of the economy. Wealthy people use short-term government securities almost like a shock absorber. When markets get volatile, these securities hold their ground. They don't panic, they don't crash, and they don't suddenly become worthless. They give the wealthy peace of mind and flexibility, two things you can't put a price on. And while everyone else is panicking, selling at losses, and scrambling for safety, the wealthy are calm because they already built safety into the system. Another overlooked benefit is predictability. The wealthy love predictable flows of money. They don't want to guess. They don't want their financial stability to depend on luck or timing. Short-term government securities let them know exactly what they're going to earn and exactly when they're going to get their money back. Predictability becomes a kind of power when your financial life gets bigger. It helps them plan, allocate, and execute with more clarity than the average person ever experiences. And the best part? You don't need millions to start thinking this way. Short-term government securities are available to anyone. They're often more accessible than people realize. The only thing separating the wealthy from everyone else is the mindset, the understanding that cash sitting around isn't protection, it's decay. So instead of letting money sleep in a bank account, the wealthy place it somewhere safe, somewhere efficient, somewhere slightly more productive. Short-term securities don't make headlines, and they won't double your money overnight. But they quietly keep your wealth from slipping backward while giving you a stable platform to build from. And that quiet, consistent strength is exactly why wealthy people use them as one of their most reliable financial tools. High-quality corporate bonds don't get nearly as much attention as flashy stocks, booming real estate, or whatever trending asset people are obsessed with at the moment. But wealthy individuals understand their quiet importance in a way most people completely overlook. They see these bonds not as exciting chances to strike it rich, but as dependable anchors that keep their financial ship steady no matter what storms roll in. When you strip away all the complexity, a high-quality corporate bond is simply a loan from you to a strong, established company, and in return that company pays you interest at a predictable rate. It's the predictability that wealthy people value so much, because in a world full of uncertainty, anything steady becomes priceless. One of the biggest misconceptions about wealthy investors is that they are always chasing big risks. People imagine them swinging for the fences, rolling the dice, and making dramatic moves. In reality, the wealthiest investors in the world spend far more time minimizing risk than taking it. They don't want unnecessary volatility. They prefer stability that still offers a respectable return. High-quality corporate bonds fit perfectly into that philosophy, giving them a reliable stream of income that feels almost like a heartbeat, steady, rhythmic, and dependable. These types of bonds are issued by companies with strong balance sheets, long histories, and reputations for paying their debts. They're not speculative plays. They're not the financial equivalent of a lottery ticket. They are a way for wealthy people to earn consistent income even when markets are messy. And that's a critical piece of their financial strategy. When the stock market takes a dip, their bonds keep paying. When the economy slows down, their bonds keep paying. When headlines get scary, their bonds keep paying. That stream of predictable income smooths out the emotional roller coaster that hits inexperienced investors who place all of their hope in stock prices going up. Another reason wealthy people love high-quality corporate bonds is the balance they bring into a diversified portfolio. Diversification isn't about owning a bunch of random assets. It's about owning assets that behave differently under different market conditions. Stocks can soar one year and fall the next. Real estate can appreciate but also slow down when interest rates climb. But high-quality corporate bonds tend to stay calm, offering structure and stability. They act like a counterweight to the more volatile assets in a portfolio. When one part of the portfolio wobbles, another part remains grounded. It's this balance that helps wealthy individuals stay confident through uncertainty. There's also something deeply practical about bonds that wealthy people appreciate. They know exactly what they're getting. There's no guessing, no hoping, no praying for the right timing. A bond outlines the interest rate, the payment schedule, and the maturity date. Everything is spelled out up front. The wealthy enjoy that clarity because they like having parts of their portfolio that are straightforward and transparent. It allows them to plan cash flow, anticipate income, and fund other investments with a sense of control and ease. On top of that, high-quality corporate bonds give wealthy people a buffer during economic downturns. When recession fears rise, the average person often panics, pulling money out of investments at the worst possible time or letting fear dictate their decisions. But wealthy investors have streams of bond income supporting them, cushioning their expenses, and giving them breathing room. They don't have to sell assets in a panic because they've built reliable income sources that keep flowing no matter what's happening outside. That comfort is something only preparation can buy. Regular investors often ignore corporate bonds because they think they're boring or because they're too focused on doubling their money quickly. But wealthy individuals know the truth. You don't build long-lasting wealth on excitement alone. You build it through consistency, balance, and smart risk management. A portfolio without stability is a house without a foundation. High-quality corporate bonds offer that foundation, giving investors peace of mind and predictable returns while the rest of the portfolio works on growth. And the great thing is, these bonds aren't exclusive. Anyone can buy them. Anyone can use them the same way wealthy people do. The real difference isn't access, it's perspective. Wealthy people understand that not all money needs to sprint. Some money needs to walk steadily, confidently, and reliably. High-quality corporate bonds allow that part of your money to do exactly that, quietly strengthening your financial base while the more aggressive parts of your portfolio pursue growth. Income-producing real estate is one of those assets that people hear about all the time, yet so many underestimate just how powerful it actually is when it comes to building long-term wealth. Most people think of real estate in emotional terms. They think of dream homes, nice neighborhoods, or a place to raise a family. But wealthy people strip all that emotion away. For them, real estate is not about how pretty the kitchen looks or how impressive the backyard is. It's about cash flow, leverage, appreciation, and tax advantages working together over time in a way that very few other assets can match. They're not thinking about where they want to live. They're thinking about what properties will pay them month after month, consistently, even while they sleep. What makes income-producing real estate so appealing to wealthy investors is the fact that it works on multiple levels at the same time. First, there's cash flow, which is king in the world of long-term wealth building. When you own a property that's rented out, you have a stream of money coming in that helps cover expenses and ideally leaves profit in your pocket. That stream doesn't rely on market conditions the same way stock prices do. People always need places to live. Businesses always need places to operate. Rent keeps flowing even when the market is bumpy. That stability is incredibly valuable, especially during uncertain economic periods. Then there's appreciation, the gradual increase in property value over time. Wealthy people don't obsess over the short-term wiggles. They look at the long-term trend. Over decades, real estate tends to rise in value. And when you combine that with rental income, you get this powerful double engine working for you. Cash flow keeps feeding your finances today, while appreciation quietly builds your wealth for tomorrow. It's like having one hand pulling you forward and another pushing you from behind, creating a force that compounds year after year. Another advantage that wealthy people absolutely love is leverage. Real estate is one of the only asset classes where you can use other people's money, usually the banks, to buy something that grows in value and generates income at the same time. You can put down a portion of the total price and still benefit from the full value of the property. If a property grows by 5% in a year, that 5% applies to the entire value, not just the amount you personally invested. That's a powerful multiplier that can accelerate wealth far faster than simply saving cash or investing small amounts into other assets. And then there's the tax side of real estate, which most people don't fully understand, but wealthy investors take full advantage of. In many cases, you can deduct expenses like mortgage interest, repairs, property taxes, and depreciation, which is basically the government acknowledging that buildings wear down over time and giving you a tax break even if the property is actually increasing in value. That alone can save thousands every year and keep more money in your pocket, allowing your real estate portfolio to grow even faster than it would on the surface. What also makes income-producing real estate incredibly attractive is the element of control. In the stock market, you can't call a CEO and tell them to run the company differently. You're essentially a passenger. But with real estate, you can decide how you want to increase value. You can improve the property, raise rents responsibly, find better tenants, or refinance to free up more capital. Wealthy people love assets they can influence directly because it gives them the power to increase income and equity instead of waiting for something to happen on its own. The other thing wealthy investors understand is that real estate creates a sense of financial resilience. Even if markets crash or interest rates rise, people still need shelter. Even if businesses struggle, the ones that survive still need physical space. Real estate rarely goes to zero. It doesn't disappear. It holds its place in the real world, and because of that, it tends to recover and continue performing over long periods of time. Wealthy people aren't looking for assets that explode in value overnight. They want assets that stand strong for decades. And anyone can start, even with something small. You don't need to buy a huge apartment building to benefit from income-producing real estate. Starting with a single rental property, a small duplex, or even investing through REITs can introduce the same principles. The real power lies in thinking like the wealthy do, focusing on assets that pay you, that grow quietly, and that give you control over your financial future rather than leaving it to chance. Broad-based index funds might be the most overlooked yet powerful wealth-building tool available to everyday people, and wealthy individuals understand this better than anyone. They know that most investors spend years trying to outsmart the market, jumping in and out of stocks, chasing hot trends, and reacting emotionally to every news headline. But wealthy people step back and look at the bigger picture. They see that over long periods, the global economy tends to grow, businesses innovate, populations expand, and productivity increases. Instead of trying to pick the next winning stock, they choose to own a slice of everything. That's the essence of broad-based index funds. They give you automatic diversification, exposure to thousands of companies, and long-term growth without the stress and guesswork that derail most investors. Index funds don't require brilliant insight or perfect timing. They don't require hours of analysis or insider knowledge. They simply track the performance of a large market index like the S&P 500 or a total world stock fund and ride the natural upward drift of the global economy. Wealthy people love this because it aligns perfectly with how they think about money. Simple, efficient, low cost, and dependable over long horizons. They're not trying to beat the market every year. They're trying to stay in the market for decades, letting time and compounding do the heavy lifting. One of the biggest advantages of broad index funds is diversification. Instead of buying a handful of individual stocks and hoping they perform, you spread your risk across hundreds or even thousands of companies instantly. If one business struggles, another thrives. If one sector cools down, another heats up. That natural balancing effect creates a smoother long-term experience, which is exactly what wealthy investors want. They understand that consistent, steady growth is far more valuable than unpredictable bursts followed by painful drops. They want the kind of growth that doesn't depend on guessing which company will outperform next year. Another major reason wealthy people lean on index funds is their incredibly low cost. Fees eat away at your returns more than most people realize. A 1% annual fee might not sound like much, but over years and decades, it can drain tens of thousands, sometimes hundreds of thousands of dollars from your investment growth. Index funds, on the other hand, often charge a fraction of a percent. Wealthy people pay attention to these details because they know that every dollar saved in fees is a dollar that can continue compounding. They prefer investments that don't require expensive management, trading, or maintenance. The low-fee nature of index funds makes them one of the most cost-effective wealth-building tools ever created. Then there's the emotional side. Wealthy people know that emotions are one of the biggest enemies of good investing. Fear and greed cause people to make terrible decisions. Selling when the market drops, buying when it's euphoric, panicking during volatility. Index funds eliminate a lot of that temptation. You don't have to watch them every day. You don't have to wonder whether your portfolio is failing. You know exactly what you own, the entire market. The wealthy embrace this simplicity because it keeps their emotions in check and their strategy consistent. Index funds also offer something incredibly valuable: time freedom. Wealthy people do not want to spend their lives monitoring markets, researching earnings reports, or babysitting stocks. They want investments that quietly grow while they focus on bigger opportunities, businesses, real estate, innovation, strategic ventures. Index funds allow them to set a long-term plan and then step back. Their money keeps working without their constant attention, which is one of the most underrated benefits of all. And finally, broad-based index funds reflect a core belief wealthy people share. Progress is built over decades, not days. They know that the stock market will fluctuate in the short term, sometimes violently, but over the long term, it has a powerful upward trend. They choose to align themselves with that long-term trend rather than getting caught up in the noise of short-term movement. They bet on human innovation, global growth, and the natural expansion of economies, and index funds are one of the simplest ways to capture that growth without complication. Hedging assets like gold, commodities, and even small allocations of crypto play a very specific role in the portfolios of wealthy individuals, and it's a role that most everyday investors never fully appreciate. These assets aren't typically used to generate high returns or explosive growth. Instead, they're used as shields, as forms of protection, as tools that behave differently when the world starts acting unpredictably. Wealthy people know that the economy moves in cycles. They know markets go through phases of expansion, contraction, inflation, deflation, stability, and chaos. What they don't do is try to predict exactly when those cycles will shift. Instead, they prepare. And hedging assets are one of the smartest ways they prepare for uncertainty. Gold, for example, has been a store of value for thousands of years. It's survived wars, crashes, depressions, currency collapses, and political upheaval. Wealthy investors don't buy gold because they think it will double in price next year. They buy it because its value tends to remain steady or even increase when the world becomes unstable. When currencies weaken, gold often strengthens. When inflation rises, gold usually holds its ground. It doesn't produce cash flow, but it sits quietly as an anchor in times when everything else feels shaky. Wealthy people love having a small part of their portfolio in gold because it gives them peace of mind when the rest of the financial system feels uncertain. Commodities play a slightly different role. They're tied to real-world needs: energy, food, industrial materials. When inflation surges and the price of goods goes up, commodity prices often rise right alongside them. Wealthy investors understand this natural relationship. Instead of trying to fight inflation, they position some of their money in assets that benefit directly from it. That way, When the cost of living increases and markets wobble, a portion of their portfolio actually gains value instead of losing it. It's not about making a fortune off commodities. It's about protecting purchasing power when inflation becomes a threat. And then there's crypto, which is the newest and most controversial member of this group. Wealthy people don't treat crypto as a get-rich-quick asset, even though a lot of inexperienced investors do. They see it as a highly volatile but potentially useful hedge against certain economic risks, particularly those related to currency systems and technological shifts. They don't go all in. They don't bet their future on it. Instead, they allocate a small slice, something like 1 to 5%, knowing that its behavior is often uncorrelated with traditional markets. Crypto can plunge, but it can also surge when conventional assets struggle. The wealthy understand that a tiny allocation can offer asymmetric potential, limited downside in their overall portfolio, but significant upside if the asset class grows. The key here is that hedging assets behave differently. They don't move in sync with stocks or real estate or bonds. They have their own rhythms, influenced by forces that often run counter to the broad market. And wealthy investors love that kind of independence within their portfolio. They understand that the real risk in investing isn't volatility, it's concentration. When all your assets depend on the same economic conditions, you're extremely vulnerable. When you diversify into assets that thrive in different conditions, you're protected. Another advantage of hedging assets is psychological. During economic storms, when markets are dropping and fear is everywhere, hedges can provide a sense of calm because they tend to hold value or even rise. That psychological stability helps wealthy people stay rational when others panic. It prevents emotional decisions. It keeps long-term strategies intact. That alone is worth more than most people realize, because staying disciplined during a downturn is often what separates wealthy investors from those who lose money at the worst possible time. Ultimately, wealthy individuals don't hedge because they expect disaster. They hedge because they respect uncertainty. They understand that the future is unpredictable, and they would rather be prepared than exposed. Hedging assets act as insurance that pays them instead of costing them. And that subtle strategic protection is one of the reasons the wealthy stay wealthy, no matter how unpredictable the world becomes. True financial safety has very little to do with how much cash you have sitting in the bank, and wealthy people understand this better than anyone. The average person believes that the more money they leave untouched in a savings account, the safer they are. But in reality, that mindset often does the opposite. It creates vulnerability because money that sits idle is money that slowly loses purchasing power, and money that isn't allocated wisely can't protect you when life takes an unexpected turn. Wealthy people operate from a very different philosophy. They know that safety doesn't come from hoarding. It comes from building a structure that can withstand different economic conditions. When you look at how wealthy individuals manage their finances, they create safety through diversification and strategic allocation. Their version of security isn't having a mountain of cash tucked away. It's having money positioned in ways that reduce risk and increase resilience. They spread their resources across assets that grow in different environments, assets that protect against inflation, assets that generate income, and assets that remain stable when markets are turbulent. Each piece plays a role, like different parts of a well-built machine that continues to function even if one component fails. One of the biggest misconceptions is that holding a lot of cash means being prepared. In reality, cash is a fragile form of safety. Inflation eats away at it quietly, turning today's value into something noticeably smaller years down the line. You might think you're being cautious, but every year your cash buys less and less. Wealthy people are very aware of this erosion. They keep enough cash for liquidity and emergencies, but everything beyond that is allocated with intention. Their money sits in places where it can either grow, protect itself, or generate income. That's where true safety is found, when your money works for you, not when it sits frozen and shrinking. Another factor the wealthy consider is predictability. They don't rely on just one type of asset or one type of return. They create different layers of financial defense. Some assets provide steady, reliable cash flow, which gives them breathing room during downturns. Others provide long-term growth, ensuring their purchasing power increases over time, not decreases. They include hedging assets or inflation-resistant assets to protect against sudden changes in the economic environment. By building this layered structure, they put themselves in a position where no single crisis can wipe out their stability. True safety also comes from understanding risk, not avoiding it altogether. People who try to eliminate all risk often end up exposing themselves to a different kind of risk, the risk of stagnation, of being unprepared for inflation, or of missing opportunities that could have strengthened their financial position. Wealthy individuals study risk thoughtfully. They look at how each asset behaves in different conditions, how liquidity works, how tax structures affect returns, and how to balance short-term and long-term goals. This isn't about fear, it's about awareness. And awareness is one of the strongest forms of safety you can build. There's also a psychological element. When your money is simply sitting in the bank, your sense of safety is fragile. One major economic shift, one spike in inflation, one unexpected life event, and that feeling of security can collapse instantly. But when your financial foundation is diversified and thoughtfully allocated, you don't panic when markets dip or headlines get scary. You have confidence because you aren't relying on a single source of stability. Confidence is a form of safety that can't be measured in dollars, and it's something wealthy people cultivate deliberately through their financial choices. The truth is that financial safety isn't something you buy, it's something you build. It's a structure made of decisions, not deposits. It's the comfort that comes from knowing your money isn't just sitting there, it's growing, protecting itself, and supporting your future. Wealthy people don't feel safe because they have more money. They feel safe because they've created systems that keep them secure no matter what the economy does. And that philosophy is something anyone can adopt, even without a fortune. You don't need to be rich to start building wealth the way wealthy people do. And that's one of the most empowering truths about money. A lot of people look at the strategies used by the wealthy and assume those methods only work if you're already sitting on a large pile of cash. But the reality is that the mindset behind these strategies is what matters most, not the dollar amount you begin with. Wealthy people don't think of money as something to be stored. They think of it as something to be utilized, something that must have a purpose. And that mindset is available to anyone, regardless of their income level or current financial situation. The difference between someone who stays stuck financially and someone who grows is often just the willingness to put their money to work instead of letting it sit still. When you start thinking like a wealthy person, you shift from asking, how much can I save, to asking, how can I make my money earn more? It's a different approach, and it opens the door to opportunities that most people overlook. You begin to realize that even small amounts of money can be allocated strategically. Maybe it's a small investment in an index fund every month. Maybe it's keeping just a portion of your savings in higher yield, low risk instruments like short-term government securities instead of parking everything in a traditional bank account. Maybe it's learning about assets that protect you from inflation like commodities or gold and allocating just a tiny percentage of your wealth there. These moves don't require wealth, they require intention. And intention compounds just like money does. Another important shift is understanding that building wealth isn't about timing the market or making perfect decisions. Wealthy people aren't trying to predict every twist and turn of the economy. They're building systems that work over time. They choose assets that grow slowly and steadily. They diversify to protect themselves from unexpected changes. They invest regularly, not just when things look good. They treat their financial life like a long-term project, not a quick gamble. Anyone can adopt this approach. You don't need millions. You just need consistency and patience, two qualities that are completely free. The mindset also includes learning to separate emotion from money. Wealthy people are not immune to fear or uncertainty, but they have learned to discipline their reactions. When the market drops, they don't panic and pull all their investments. They understand that volatility is normal, that markets rise and fall in cycles, and that staying invested is often the smartest choice. If you build this discipline early, even with small amounts of money, you set yourself up for long-term success. Emotional control isn't a luxury of the wealthy, it's a skill anyone can practice. Another piece of the mindset is focusing on growth rather than appearance. A lot of people think wealth building means looking wealthy, buying nicer things, upgrading lifestyle, spending more when they earn more. Wealthy people do the opposite. They prioritize investments over image. They put money into assets before they put money into things that lose value. And the amazing thing is that you can start practicing this even with limited income. Choosing to invest before you upgrade your lifestyle is a habit that builds real financial strength over time. There's also something powerful about learning as you go. Wealthy people aren't born with financial knowledge. They acquire it by paying attention, experimenting, reading, asking questions, and making mistakes. You don't have to know everything to start. You just have to be willing to take the first step and then improve step by step. The knowledge builds alongside the wealth, and soon the decisions that once felt intimidating become second nature. Ultimately, adopting the mindset of giving every dollar a job is what separates financial stagnation from financial progress. When you stop treating money as something to hoard and start treating it as a tool, everything changes. Even if you start with small amounts, those small amounts grow, compound, protect you, and eventually transform your financial life. Wealth doesn't begin with wealth. It begins with behavior, perspective, and the courage to use what you have wisely.